Understanding Real Estate Market Cycles. Fred E. Foldberry was a lecturer in economics who also did research at the Independent Institute. In 1997, Professor Foldberry noticed that the next major economic recession would occur around 18 years after the 1990 recession, barring any major unforeseen events such as a global war. More recently, the Great Recession of 2008 significantly impacted the U.S. economy and real estate markets, as well as economies of other countries around the world. That began our quest for understanding and expanding our financial education, particularly for any source of information that would lead to our financial freedom. Although the last recession was a surprise to many people, it is possible to predict housing trends by observing real estate cycles. First, let's cover what is a real estate cycle. Researchers have observed that real estate markets have a predictable 18-year cycle that they have been following since 1876. Up until 1925, the real estate cycle ran like clockwork through four main stages. First was recovery with declining vacancy and no new construction. During the recovery phase, the economy may have characteristics of a recession. The unemployment rate is high and people are not spending as much money, so real estate prices are more affordable. Second was expansion with declining vacancy and new construction. As available property becomes harder to find, the price of housing will increase as more people compete for a limited number of homes. Third was hypersupply with increasing vacancy and new construction. Even though there are more people living in places than usual, rental prices are still going up. The increasing rental rates encourage new construction, with developers and investors building for a future market. Finally, recession where vacancy continues to increase as more completions are brought to market. Although there is a time lag between when people demand property and when new construction is completed, often more construction is finished just as a recession starts. As inventory levels increase and economic growth slows down, vacancies begin to rise. However, the 18-year real estate cycle was interrupted by government regulation beginning in 1925. During the Great Depression from 1929 to 1939, as well as during World War II and more recently with the Federal Reserve's yield curve control and quantitative easing programs, the real estate market has been impacted by skyrocketing government regulation and intervention. Here are some rules to profit from the 18-year property cycle. Don't panic and sell a property just because prices are falling. Don't put yourself in a position where you're forced to sell at the wrong point in the cycle. Don't get carried away, like everyone else is, during the winner's curse phase. This is the worst possible time to buy a property, because prices will soon fall and won't recover to the level you bought at until relatively late in the next cycle. Don't get misled by the media. Always keep adequate cash reserves to cover potential expenses. If you focus on the basics, you will already be doing much better than most non-professional investors. But if you want to push it even further, there are some more advanced options that knowledge of the cycle makes possible. First, be a seller when everyone else is buying. Second, be a buyer when everyone else is selling. Third, stockpile your cash during the winner's curse phase, so you're prepared to swoop when everyone else is selling. Learn more at 40plusfinance.com.